Welcome back to Korea Market Explained. Today we answer the question that every investor asks the first time they look at Korean stocks. Why is it so cheap? Here's the puzzle. Samsung Electronics, one of the world's largest semiconductor companies, ran its chip division at over 20 trillion won in quarterly operating profit in late 2025. It has a balance sheet most CFOs would kill for, and yet for years it traded at less than 1 times PBR value. That means the market was valuing Samsung, plant, equipment, patents, cash and all, at less than what you'd get if you just liquidated the assets. This isn't a Samsung problem, it's a Korea problem. The S&P 500 trades at around 4.2 times PBR value. The MSCI Emerging Markets Index, which includes far riskier economies, trades at 1.7 times. Kospi, around 0.9 times through most of 2025, though by 2026, as reform momentum built, that had started to move toward 1.3 to 1.5 times. Korean companies earn real profits, pay dividends, and sit on enormous cash reserves. For most of the last decade, the market priced them at a persistent discount to their net asset value. That gap has a name, the Korea discount. And understanding it, why it existed, and what finally started to close it, is the most important thing you can learn before putting a single dollar into Korean equities. Let's start with the numbers. PBR measures how much investors pay for every dollar of a company's net assets. A ratio above 1.0 means investors believe the company creates value above its balance sheet. Below 1.0 means they don't. For most of the last decade, Kospi sat below 1.0, and by 2025 it was still around 0.9 times. Compare that to Japan's Nikkei at 2.1 times, MSCIEM at 1.7 times, even Hong Kong's Hang Seng, which has its own serious structural problems, at 1.1 times. By 2026, Kospi had re-rated to somewhere in the 1.3 to 1.5 times range as reform momentum accelerated. That's a meaningful move, but to understand whether it lasts, and whether there's more to come, you need to understand why the discount existed in the first place. The real question isn't whether a discount existed, it's what caused it to be so persistent, and what is genuinely changing? There are 5 structural reasons for the Korea discount. The first is the chaebol. Korea's economy is dominated by large family-controlled conglomerates, Samsung, Hyundai, LG, SK, Lotte, known as chaebol. These groups account for over 60% of Kospi market cap. Here's the governance problem. Founding families often own just 2 to 5% of the flagship company, but control 100% of decisions through a web of cross-shareholdings. Minority shareholders, which means you, if you own Kospi stocks, have historically had very little power. Profits get recycled within the group rather than returned to investors. Acquisitions get made to benefit the family, not the stock price. The second reason is North Korea. It sounds almost too simple, but it's real. Global institutions apply a war risk premium to Korean assets. During missile tests, Kospi routinely drops. Some large pension funds have internal risk limits that prevent them from holding significant Korea exposure at all. This is a permanent overhang that no reform can fully remove. Reason 3, historically low shareholder returns. Korean companies have been notoriously reluctant to return capital, not just through dividends, the yields are actually okay, but through buybacks and cancellations. Samsung held over 100 trillion won in net cash at end 2024. That's roughly $75 billion sitting on a balance sheet, earning nothing for shareholders. Reason 4, governance opacity. Until very recently, Korean companies filed disclosures only in Korean. Foreign investors couldn't easily read earnings, board changes, or material events. Independent directors often rubber stamp management. Related party transactions between chaebol subsidiaries at non-market prices are common and legal. Korea scores near the bottom of Asia Pacific on MSCI governance metrics. The fifth reason is perhaps the most structural, MSCI classification. Korea has a GDP per capita higher than Portugal, Spain, and New Zealand. By any economic measure, it's a developed market, but MSCI classifies it as emerging markets. Why does this matter? Developed market funds, which manage roughly 10 times more assets than emerging market funds, cannot allocate to Korea. Korea makes up about 12% of the MSCIEM index, so the only institutional investors who are forced holders of Korean stocks are EM specialists, who already have plenty of other high-growth options. The developed market premium, the lower discount rate that investors apply to stable, liquid, accessible markets, never flows to Kospi. Now here's the interesting part. If Korea were upgraded to MSCI developed, it would enter MSCI World at roughly 1 to 2% weighting. That doesn't sound like much. But MSCI World is benchmarked by trillions of dollars of passive and active funds. Analysts estimate the forced inflows would be in the range of $50 to $80 billion. A single reclassification decision would be the most significant capital event in Korean equity market history. For decades, investors knew about the Korea discount, shrugged, and moved on. Then something changed. In February 2024, the Korean government launched what it called the Corporate Value Up program. The template was explicit: Japan. In 2023, the Tokyo Stock Exchange told listed companies trading below 1.0 times book to either explain themselves or fix it. The result was one of the most significant market re-ratings in recent memory. Japan's market went from being a value trap to one of the best performing in the world. Korea's FSC, its financial regulator, announced the same approach. By May 2024, large Kospi companies were required to publicly disclose their P/B analysis and capital return plans, or explain why not. In November, tax deductions were introduced for companies that raised dividends or buybacks above prior year levels. By 2025, KRX had launched a dedicated Value Up index, and institutional funds began benchmarking against it. That last part matters. When fund managers need to track an index, they have to buy the stocks in it. Incentives changed. One more piece. Korea's commercial code was amended in 2025 to extend board fiduciary duty to all shareholders, not just the controlling family. That's a direct legal hit on the foundation of chaebol minority abuse. We'll cover this properly in a separate episode. And companies responded. KB Financial, Korea's largest bank, set an explicit PBR target of 1.0 times, committed to 50% total shareholder return ratio, bought back $1 trillion of stock in 2024, its share re-rated from 0.5 times to 0.75 times PBR. Hyundai Motor announced a $4 trillion buyback with actual cancellation, not the old trick of buying shares and warehousing them. Its stock moved from 0.4 to 0.6 times PBR. These aren't isolated cases. Across Kospi, the direction of travel has clearly changed. So, is the discount actually closing? The honest answer is partially and slowly, but the debate is real. The bull case is compelling. Japan's TSE reform was the same playbook, and Japan went from 1.0 times to 1.8 times PB over 3 years. The MSCI upgrade would force 50 to 80 billion in institutional buying. The chaebol governance shift is generational. Third-generation heirs are more focused on stock price and capital efficiency than their founders were. English disclosures are now required for large companies. The IRC, a registration requirement that was a major access barrier for foreign investors, was abolished in April 2025. The bear case is also real. The Value Up program is voluntary. Companies without real shareholder pressure can ignore it. Chaebol governance reform has been imminent for 30 years. The MSCI upgrade requires FX settlement reform that Korea hasn't fully delivered yet. North Korea isn't going anywhere, and even the optimists note that Japan's re-rating took 4+ years. Korea investors need patience. But for the first time in a long time, the structural incentives are pointing in the right direction. If you're investing in Korea, or watching from the sidelines, there are 3 numbers to track. First, Kospi PBR, currently around 0.9 times. A sustained move above 1.0 is your first signal that the re-rating is real, not a spike, a trend. Japan moved from 1.0 to 1.8 over 3 years. Korea, moving to 1.2 times PBR, would represent a 30+% re-rating on valuation alone. Second, the MSCI review. MSCI announces decisions in June each year. Korea doesn't need a full upgrade to move markets. Being placed on watch list alone would trigger institutional pre-positioning. The FX settlement reform, moving to T+2 DVP, is the key remaining hurdle. If Korea clears that, the upgrade conversation becomes very serious. Third, buyback cancellation rate. This is the one most retail investors don't know to watch. Korean companies have historically bought back shares and kept them as treasury stock, which does nothing for shareholders. What matters is cancellation, actually retiring the shares so the remaining ones are worth more. In the US and Japan, cancellation rates run above 80%. In Korea, it's been closer to 40%. Watch for that number to move above 70%. When it does, it means governance has genuinely changed, not just the optics. Here's the takeaway. The Korea discount is real, persistent, and structural. It was built by chaebol governance, geopolitical risk, low shareholder returns, opacity, and MSCI classification. But it is not permanent. Japan proved that governance-driven re-ratings happen. Korea is running the same playbook, 3 to 4 years behind. The Value Up program, tax incentives, English disclosures, and the MSCI upgrade conversation are all moving in the same direction for the first time simultaneously. Whether that translates into a full re-rating is still an open question. The structural headwinds are real, but so is the opportunity. The Korea discount is the single most important concept for anyone investing in Korean equities. If you understand it, you understand the whole board. Next episode, we cover the practical side, how foreigners actually access Korean stocks, ETFs, ADRs, direct accounts, and what the FX impact really means for your returns. Subscribe if you haven't already. I'll see you in the next one.